Welcome to this week's market drama. It's actually the last market drama for the year. We'll pick it up in January. So happy holidays to everybody. The S&P was up 2.5% this past week. Year to date is now up 23%. NASDAQ was up even more, up 2.8%. It is up now 42% year to date. It is the seventh consecutive week of positive returns. And for the month of December, the S&P's up about 5%, right? So we've really had a good run so far. What was the catalyst? This past week, we had the Federal Reserve meeting. That by far was the main catalyst, right? If you saw the market action, and essentially when we had the strongest return was in the second half of the week after the Federal Reserve meeting. And so what happened during that meeting that made the market feel even more optimistic about the future? Well, one, the Federal Reserve puts out these dot plot, which essentially each voting member gives us a sense of where they think interest rates will be, about 3 months out, 6 months out, 12 months out. And the dot plot pointed to 3 rate cuts in 2024, which is more than the 2 cuts that they had estimated in the prior reading in September, right? So essentially, the Federal Reserve looks for more rate cuts next year. And during the press conference, Chairman Powell noted, and I quote, "You want to be reducing restriction on the economy well before 2% in inflation so you don't overshoot. It takes a while for policy to get into the economy, et cetera, et cetera." So what he's basically kind of signaling here is that inflation doesn't have to reach 2% for the Fed to start cutting rates, right? So you combine those dot plots with his commentary, and the market really liked it. The 10-year Treasury bond yield is down now nearly 30 basis points, 0.3% this week as well, and down over 1% since the high in mid-October, bringing yields to under 4%, which is the lowest since July 1st of this year, right? So we had the Fed kind of forecasting that they're going to actually lower interest rates more than they were telling us before. Why? Because inflation is coming down a fair bit, and they're also telling us they don't have to wait for inflation to be 2%, right, for them to start cutting. That really sets a strong recipe for the stock market, considering the economy has held up, right? We've seen kind of that soft landing of inflation coming down, while the economy not seeing a recession. Now, what's most interesting from a market dynamics is not only that it's gone up, but if we look at this past couple of weeks, interest rate sensitive parts of the stock market are performing better, right? Small cap stocks rose over 11% this month so far. S&P real estate sector is up over 12% versus the overall S&P up a little bit over 5%, right? So we are seeing a broadening of stock participation instead of just the usual suspects on large cap technology stocks driving the market. And we continue to see that going into next year. It could give even more legs to the market rally. Obviously, a lot of other things dependent, such as the economy, earnings, et cetera. So that is it for this week. As I mentioned in the beginning, we will pick this up after the New Year's. Happy holidays, Happy New Year's. See you next year.